Welcome to the deep dive. We're here to cut through the noise, really give you the insights you need to stay informed.
Yeah, absolutely.
And today, we're tackling a big question, one I know is on the minds of a lot of American investors right now. Where are those truly innovative opportunities, especially in, the financial sector? It's changing so fast.
That's a perfect starting point.
Huh.
And our mission today really is to do a deep dive specifically for you, the investor listening in. We're going to zero in on one company that's right at that crossroads, the intersection of AI and fintech.
Which company is that?
Pagaya Technologies Ltd. Think of us maybe as your personal stock analyst for the next little while here.
Yeah.
We're aiming for really comprehensive evaluation, looking at the company, its market, the bigger economic picture.
Oh, from today's perspective, right?
Yeah.
July 27, 2025.
Exactly. That's our analysis point.
Okay, so what's the plan? How are we breaking this down?
Well, first, we'll unpack Pagaya's business model, their tech, get a good handle on what they actually do. Then we'll hit the numbers, the financials, recent performance, the cold, hard data.
Good.
After that, we kind of zoom out, look at the industry trends, the macro environment affecting them.
Crucial context.
Definitely. And finally, we'll lay out the risks, weigh them against their strengths, their competitive edge. The goal is for you to walk away with a really solid, nuanced understanding of this potential investment.
Excellent. Let's get started then. Where do we begin with Pagaya?
Okay, Pagaya. At its core, their business is about using AI, artificial intelligence, and just vast amounts of data to assess credit risk.
Across different types of loans?
Yeah, exactly. Personal loans, auto loans, even home equity loans. But here's a key point. They don't actually make the loans themselves.
Okay, so they're not a lender in the traditional sense.
Right. They use their AI to assess these loans, then they bundle them up, package them into portfolios,
And sell those.
and sell them off to big institutional investors. It's quite clever. They aim to boost financial efficiency, reach customers that maybe traditional methods overlook.
Underserved borrowers, maybe?
Precisely. And at the same time, they're creating these, diverse asset-based investment products for the big financial players.
Talk more about the AI. You mentioned this AI network. What makes it special?
Yeah, the AI network, it's really their crown jewel. It's not just some simple algorithm. Think highly sophisticated machine learning trained on literally millions of loan data points.
Millions. Wow.
Yeah. So imagine someone, maybe self-employed, fluctuating income. Traditional credit scores might just say no.
Right. FICO might flag them.
Exactly. But Pagaya's AI might look at, say, consistent rent payments, utility bills, maybe job stability trends from, non-traditional data sources.
Things FICO doesn't see.
Right. And it might unlock a loan for that person. That opens up a huge potential market for Pagaya. And crucially, they claim it predicts creditworthiness more accurately, managing risk better for their partners.
Okay, so that's the tech. How does it translate into a business model? Are they competing head-to-head with banks, or is it different?
That's a great question. It's fundamentally collaborative, actually. They partner with existing lending institutions.
Banks, credit unions?
Yep, banks, credit unions, even other fintech lenders. They integrate their AI network right into those partners' loan processes.
Ah, okay, so the partners use Pagaya's tech.
Exactly. Which allows those partners to say yes more often, reach a wider customer base, often those underserved folks we mentioned. And of course, that means more revenue for the partner.
And that partnership then fuels Pagaya's main business, right?
Yeah.
Facilitating the whole thing.
You got it. They don't lend, but they acquire these loan assets from their partners. Then they package them up, often into what are called asset-backed securities, or ABS.
Right. Pooling loans together.
Yeah. Thousands of individual loans pooled. And then they sell shares in that pool to institutional investors, hedge funds, pension funds, insurance companies.
And the fees from those sales are Pagaya's main revenue.
That's the core. It's a neat dual focus. The more lenders use their AI, the more quality loan assets Pagaya has to package and sell.
So it feeds itself.
It's like a self-reinforcing supply chain, yeah.
Okay, so the target market is two-sided. Lenders looking to modernize and grow, and institutional investors looking for these alternative, maybe higher yield investments.
Spot on. And it's worth noting that potential social impact too, right? Expanding access for people locked out by old school credit scores.
Definitely. So what really gives them an edge? What's their competitive advantage in this crowded space?
Good question. Well, first, it's that unique AI. We talked about its sophistication. It seems to go beyond typical financial modeling.
Right.
Second, economies of scale, and that network effect. This is key. More data from more partners makes the AI smarter.
Improving accuracy.
Exactly. Which
Mhm.
attracts more partners and more investors. It's that virtuous cycle.
Got it.
And third, don't underestimate their specific expertise in this niche of asset-backed investments. Structuring and selling these loan portfolios to institutions is a specialized skill. Not everyone can do it well.
That all sounds pretty compelling. But let's bring it back to the listener. What does this mean for you, the investor looking at Pagaya?
Okay, so for you, the investor, it means Pagaya presents this exciting growth story. But its trajectory is highly sensitive.
Sensitive to what?
Changes in the financial markets, definitely. Things like interest rates, market liquidity, and of course the continued evolution and adoption of AI itself.
So high potential, but also high sensitivity.
You nailed it. It's that kind of investment profile.
Okay, the model sounds innovative. The AI seems powerful, but does it actually make money? Let's dig into the financials. Peel back the layers there.
Absolutely. Time for the numbers.
Yeah.
So when you look at Pagaya's revenue, the biggest piece is what they call network fee revenue.
Network fee revenue.
Yeah. And that fee is tied directly to network volume,
Which is?
the total dollar amount of loans processed using their AI network. This metric, network volume, is probably the single most important indicator of their platform's growth and how much is being adopted.
Okay, so volume drives fees. Makes sense. Anything else on the revenue side?
Yeah, they also have some revenue from management services, other smaller fees, and then there's something called net gain on financial instruments.
Sounds technical. Break that down for us.
Sure. Think of it as earnings from Pagaya's own investments in some of these loan assets. It shows they have some skin in the game, but it also means that part of their earnings is exposed to market volatility.
Like a small trading desk within the company almost.
Kind of, yeah. It can add profit, but it adds risk too.
Yeah.
On the cost side, the big buckets are pretty typical for a tech-focused company.
Like R&D.
Exactly. Research and development is significant. They're constantly refining that AI model. Then you've got sales and marketing, got to grow that partner network and the usual general and administrative or G&A costs.
Now, profitability, I've seen they often report a GAAP net loss. That might worry some investors. What's the story there?
That's a really crucial point to understand. For a company like Pagaya in high growth mode, a GAAP net loss isn't automatically a disaster because it often reflects heavy investment back into the business, scaling the AI,
Yeah.
grabbing market share. Big, sometimes non-cash, expenses related to growth.
Okay.
But here's what's interesting. While a GAAP number might be negative, they often report positive, non-GAAP adjusted EBIT.
Adjusted EBIT. Okay, what does that tell us?
Think of it as looking at the core operational profitability. It strips out things like stock-based compensation, amortization, some of those big growth or non-cash items to give you a sense of whether the underlying engine is actually generating cash before those adjustments.
So it suggests improving operational efficiency.
That's the idea, yeah. You also want to watch their operating cash flow, ideally positive, showing they can fund operations internally. And like any growth company, keep an eye on debt levels and cash reserves. You can't skip checking the balance sheet health.
Right. So boiling it down for our American investor audience, what are the absolute must-watch metrics for Pagaya?
Number one, without a doubt, network volume growth rate. That tells you if the core platform is expanding. Number two, that adjusted EBITDA trend. Is it growing? Is the margin improving? That shows efficiency gains.
Got it. And looking at their recent performance, what have those key metrics been showing?
Well, you need to track that network volume growth quarter by quarter, compare it to what the market expects.
Yeah.
That's paramount. Overall revenue growth, mainly from those network fees, is obviously tied to that.
And profitability.
You want to see continued improvement in adjusted EBITDA and hopefully a shrinking GAAP net loss over time. That signals they're moving towards sustainable profitability.
Any other signals to watch?
Definitely keep an eye on announcements of new partnerships with financial institutions. Each new partner validates the model and adds to potential volume.
And their own forecasts.
Absolutely critical. Pay close attention to the company's forward-looking guidance, what they expect for network volume, revenue, adjusted EBITDA. It shows their own confidence level.
Okay. Important note here, though, right? Fintechs, especially in lending, are very sensitive to the economy.
Huge point. You cannot forget this. Things like rising interest rates can seriously dampen loan demand. And maybe more importantly, they can increase delinquency rates people struggling to pay back loans. That hits Pagaya's model directly.
So the macro environment is key, which actually leads us perfectly into our next section. Pagaya's AI might be impressive, but it exists in a wider world. We need to zoom out, look at the industry and macroeconomic forces at play.
Exactly. You can't analyze a company like this in a vacuum. Let's start with the broader fintech and AI landscapes.
Okay. What's driving growth there?
Well, in fintech, it's pretty clear. Rising demand for digital everything in finance, traditional players scrambling to transform digitally, and this real push for greater financial inclusion.
Making services available to more people.
Right. And on the AI side, just an explosion, more data than ever, way more computing power, huge leaps in machine learning algorithms. AI is getting plugged into everything.
What specific trends are impacting companies like Pagaya?
We're seeing AI driving hyper-personalization, automation everywhere. There's embedded financial services popping up inside non-financial apps.
Like getting loan options when you're buying a car online.
Exactly. Also, RegTech, using tech to handle regulations, is growing. And there's increasing focus on data governance, AI ethics, which is critical when you're dealing with people's financial lives.
And the competition, who are they up against?
It's a busy space. You've got other AI-driven fintechs like Upstart or Lending Club doing similar things.
Okay.
Then you have the big traditional banks and lenders who are definitely not standing still. They're building or buying their own AI capabilities fast.
Can't count them out.
Absolutely not. And then there's the potential elephant in the room, big tech. Could companies like Google or Amazon decide to jump deeper into lending? It's always a possibility.
Okay, that's the tech side. What about the broader financial industry trends that directly hit Pagaya's actual business?
Yeah, good distinction. Here we're looking at the health of the specific loan markets they're in. Consumer loans, auto, home equity. How big are they? Are they growing? The credit cycle is massive. In an expansion, loan demand is usually up. Delinquencies are low, good for Pagaya. In a recession, demand drops. Defaults rise, bad for Pagaya.
And that securitization market you mentioned earlier, selling those bundles of loans.
Crucial.
Yeah.
The health of that market, meaning are investors willing and able to buy these asset-backed securities, directly impacts Pagaya's revenue.
Yeah.
That market is sensitive to liquidity, interest rates, general investor risk appetite.
Regulatory changes too, I assume.
Big time. New rules around consumer protection, how data can be used, caps on interest rates. Any of that could force Pagaya to adapt. Think about data privacy laws like GDPR or CCPA if they restrict access to the alternative data Pagaya uses.
It could impact their AI's edge.
Potentially, yeah. They'd need to adjust their models, maybe find new data sources. It's a constant balancing act.
Okay, now let's pull back to the widest lens.
Yeah.
The macroeconomy. What are the big levers here?
Interest rates. Number one with a bullet for a company like this. Sustain high rates. That can really kill loan demand and push up defaults.
Hurts growth, hurts asset quality.
Exactly. And it tends to hammer the valuations of growth stocks like Pagaya. On the flip side, if rates start coming down, that could be a major tailwind, stimulating loan demand, boosting investor confidence.
What about inflation?
Inflation can squeeze consumers, making it harder to repay loans. It can also potentially increase Pagaya's own operating costs.
And overall economic growth, GDP.
Standard relationship, mostly.
Yeah.
Recession usually means less loan demand, more defaults, bad for Pagaya's growth. Economic expansion fuels it.
Any other macro factors?
Briefly, things like exchange rates matter if they expand significantly internationally. And geopolitical risks can always shake investor sentiment and create market volatility, which impacts everyone.
So the big takeaway here is, even with cool tech, Pagaya is really tied to the mast of the broader economy.
Absolutely.
Yeah.
Especially interest rates and the credit cycle. If you're investing here, you have to keep a close eye on those macro trends. It's not optional.
Okay, that makes sense. So we understand the model, the numbers, the external forces. Now, let's get into the nitty-gritty for investors, the risks versus the strengths. What are the potential pitfalls here? The red flags.
All right, risk factors. Number one, as we just discussed, is that sensitivity to the macroeconomy and the credit cycle.
Right, high rates, recession.
Exactly. Sustained high rates, a jump in unemployment. These things can directly increase loan defaults within Pagaya's network, hitting their volume and revenue hard. You can't understate that linkage.
What else?
That asset securitization market volatility. If liquidity dries up or regulations change suddenly, making it harder for them to sell those loan bundles.
It cuts off a major revenue stream.
Precisely. Then there's the AI model itself. It's their strength, but also a potential risk. Well, could its accuracy decline if the economy shifts dramatically and the model doesn't adapt quickly enough? That's a risk. Also, the potential for hidden bias in the AI. That could lead to legal challenges, reputational damage. It's a huge focus area in AI ethics now.
And regulatory risk around the AI, too.
Definitely. New rules specifically governing AI and lending, data privacy tightening further, maybe caps on the types of loans they facilitate, compliance costs could rise, or their model might need significant changes.
And just the pace of change in tech.
Right. Technological obsolescence.
Yeah.
What if a competitor develops a better AI? Or the big banks catch up faster than expected with their own internal tech? Competition is fierce.
Other risks.
Data security is massive. They handle incredibly sensitive financial and personal data. A breach would be catastrophic financially and in terms of trust.
Sure.
There's also partnership dependency. They rely on those banks and lenders. If a few key large partners leave, that directly impacts network volume.
And finally, valuation. Growth stocks often trade at high multiples.
Yeah, that's a risk too. A high price-to-sales ratio, for example, implies high expectations for future growth. If that growth disappoints, even slightly, the stock price can correct very sharply. Continuous monitoring is key there.
Okay, that's a sobering list of risks. So let's flip it. How does Pagaya stand out against competitors? We mentioned banks, Upstart, Lending Club, even credit bureaus getting into AI. What's Pagaya's specific edge?
That's the key question for the investment thesis, right?
Right.
So unlike, say, Lending Club, Pagaya isn't primarily originating loans directly and holding that credit risk.
They're partnering.
They're partnering.
Yeah.
And unlike maybe a big bank just improving its own underwriting, Pagaya is building this two-sided network, lenders on one side, institutional investors buying the assets on the other. That's quite different.
And the AI itself.
Their specialization seems to be in using that alternative data to accurately assess these new credit populations, the ones missed by traditional FICO. That's a specific niche.
So using data others don't or can't.
Or don't use as effectively, yeah. They're looking at hundreds of thousands of data points beyond the basics, transaction patterns, digital footprint, job data,
To build a fuller picture.
a much fuller picture. They use complex machine learning, like deep learning, to find subtle, nonlinear patterns in that data that predict risk better than simple models might.
And you mentioned it learns continuously.
That's a huge part of the potential advantage. The models aren't static. They retrain constantly on new data, every loan application, every payment or default, so they can adapt to changing market conditions much faster than old-school fixed credit scorecards.
Like a living system.
In a way, yeah.
Right.
It optimizes risk prediction, helps structure portfolios for investors, and it's all built on scalable cloud infrastructure, uses APIs to connect easily with partners, and needs robust data management to keep it reliable. Plus, it enables faster automated underwriting decisions.
Okay, tech and model advantages noted. What about the company itself? The internal strengths, leadership, talent.
Crucial factors. Reports suggest their leadership has a strong mix. People who understand both the deep AI data science side and the complexities of the financial industry. That combo is rare and valuable.
Need both.
You really do. They also seem to have been successful at attracting top AI engineers and data scientists, which is a war for talent right now.
Yeah.
Retaining them is key to staying ahead.
And managing all those relationships.
That's another core skill. Juggling partnerships with banks and keeping sophisticated institutional investors happy requires real expertise in relationship management.
Compliance, too, must be huge.
Absolutely. Strong internal controls around risk management, especially watching for AI bias, ensuring data security, and navigating that evolving regulatory landscape that's table stakes, but essential.
And the culture.
Seems to be very growth-oriented, adaptable, innovative, able to move quickly, which you need in fintech. And underlying it all is the scalability of the platform itself. The ability to handle more data, improve the AI, and expand into new markets or asset classes over time.
Okay, so pulling it all together, what's the final thought for our American investor listener considering Pagaya Technologies?
Well, Pagaya is clearly an innovative player. There's significant growth potential here, especially if you believe in the long-term trend of AI transforming finance and the mission of expanding financial access. It fits that growth investor profile.
Best.
But it comes with substantial risks. We've hammered this point, but the macro sensitivity, especially to interest rates and the credit cycle, is real. And there are inherent complexities and risks around the AI itself.
So not for the faint of heart, perhaps?
Probably not, or at least not without understanding those risks clearly. As always, you absolutely must do your own homework.
Right. Don't just take our word for it.
Definitely not. Read their latest SEC filings, the 20F, the 6Ks, look at different analyst reports, and most importantly, make sure it aligns with your personal investment goals, your timeline, and your tolerance for risk.
And keep watching it, right? It's not a set it and forget it stock.
No way. Continuous monitoring is absolutely essential for a dynamic company in a rapidly changing sector like this.
Okay, so let's quickly recap. Pagaya Technologies Ltd., an AI-powered fintech aiming to disrupt lending. High growth potential by serving underserved borrowers and creating unique investments.
But facing significant headwinds from macroeconomic factors, competition, and the inherent challenges of deploying AI responsibly and effectively in finance.
We really hope breaking this down helps you contextualize Pagaya within your own investment strategy. Think about your goals, your risk appetite.
Yeah, use these insights as a starting point for your own analysis. Be informed.
And if this deep dive was helpful for your investment analysis, please do consider subscribing. We bring these kinds of expert insights regularly.